Recording has started.
Namaste, good evening, and I welcome faculty for the day, for the evening, CA Dr. Girish Ahuja ji. We have along with us Honorable Vice President, CA Dr. Devashish Mitra. I have my council colleague, CA Anuj Goel, and this is the first webcast for this council year from Direct Taxation Committee. And what a topic and what a faculty. We have topic of Finance Act. On 28th of this month, the Finance Bill 2020 was enacted. It has been signed by the President and now it has become the Finance Act 2021. And we immediately requested that first program of DTC should be with CA Dr. Girish Ahuja, under whose patronage this Direct Taxation Committee has always worked. Before I request Vice President and other dignitaries to talk, let me tell about Direct Taxation Committee. At this committee, we have decided to come out with certain small booklets of the topics which would be of great importance to the cross-section of membership. Firstly, we are going to revise a couple of publications which were already there. First and foremost is Guidance Note on Tax Audit, which requires revision because it has come out several years ago. So that work is on. Secondly, two publications on charitable and religious institutions. One is Taxation of Charitable and Religious Institutions, and other is Audit of Charitable and Religious Institutions. These two publications we will also be revising. There are some new topics which have come up via this Finance Act and which need some elucidation, some understanding to the profession and particularly the cross-section of the society. So on 4 topics, we will also be releasing certain booklets. First is relating to faceless assessment, because now the faceless assessment is order of the day and there may be various nitty-gritties. Maybe one will have to take representation letter, how to go about it, we will have to understand. Secondly, about faceless appeals. Faceless appeals are posing some challenge because when you present 200-300 pages paper book, how to really make the appellate authority understand without being there physically present, one will have to understand it. So another book will be on faceless appeals. As far as reassessment proceedings are concerned, there are certain changes. We will come out with one small booklet on reassessment proceedings. And now new settlement scheme has come for incomes up to 50 lakh rupees rather than going through the process of elaborate process of appeals and other things. Government has come out with procedure to settle the differences. So on that also we have decided to come out with booklet. So if any one of you is interested in contributing, giving inputs to these particular publications, you are welcome. If you want to suggest any such topic on which we should have a booklet guidance from the ICAI, that also is welcome. Along with me, recently our Vice Chairman CA Satish Gupta has joined from Jaipur. So I also welcome Satish Bhai, and it's indeed his association with this particular committee is of great help. Because on a number of occasions he keeps on meeting Finance Minister through Rajasthan Tax Bar Association and various other bodies. Anuj Goel is also with me. He is also very actively supporting our initiatives. President of the Institute and who is also expert in direct taxes, CA Nihar Jambusariya ji. He was also supposed to join us. However, due to certain work at Mumbai, he could not come, and at this moment he is flying to Delhi. So if he comes within time, we hope that he will also join and offer his views. So before I request Vice President sir to talk, I would request Anuj Bhai to offer his opening remarks for a couple of minutes.
Thank you, Honorable Chairman of Direct Tax Committee, one of the most prominent committee of the ICAI, Chitle sir, Honorable Dr. Girish Ahuja sir, I think the guru of all of us, and Honorable Vice President, sir, CA Dr. Debashish Mitra ji, Honorable Vice Chairman, sir, CA Satish Gupta ji, and all our honorable viewers. I think just after passing this finance bill, we are having this very, very important webinar of the Institute of Chartered Accountants of India, of the Direct Tax Committee, and we are having the best of the resource person, none other than CA Dr. Girish Ahuja, sir. And I think in spite of the fact that we are having the GST in place, we are having various other opportunities for the chartered accountants. I think each and every chartered accountant is practicing in direct taxes, in income tax particularly. And now, as a lot number of changes are there, e-assessment are there, appeals are also in electronic way. So how in the this new era of direct taxes, how in this new era of income tax, the chartered accountants have to adjust themselves. I think I will request Dr. Girish Ahuja ji to address this aspect also, because lot number of chartered accountants, even juniors also, even the youngsters also, do say a lot number of times that as now e-assessments are there, e-appeals are there, so it would be very difficult to have the justice to the assessees. So I think Dr. Girish Ahuja ji is the best person to address that apprehension also. And a lot number of changes are there. I will not be taking your further time, as we are very eager to hear our Honorable Vice President, sir, and then Dr. Girish Ahuja ji. So I once again welcome on behalf of Institute of Chartered Accountants of India, Direct Tax Committee, all of you. Thank you very much.
Well, thank you, Anuj bhai. Vice President, sir, before I invite you to talk, let me also appraise you. You informed me that the server of Income Tax Department is going very slow and there are difficulties in uploading returns of income. We have appraised this difficulty to the Central Board of Direct Taxes. We were informed that in last couple of days, maybe around 5.5 lakh returns have been already uploaded. But then they are also trying to overcome this particular difficulty. So this may be, I thought that I will communicate you because you have raised this issue. And maybe all those who are attending this webinar will also understand that we have already sounded it to the Central Board of Direct Taxes. Thank you. With that, may I invite you, CA Dr. Debashish Mitra, to address.
The Chairman of the Direct Tax Committee, my good friend Chandrasekhar Chitle, the Vice Chairman Satish Gupta ji, very senior council colleague, very experienced Anuj Goyal ji, and of course, a gentleman whom we universally call as Guru on direct taxes, Dr. Girish Ahuja, whom we can see on the screen. To all those professionals who are, part of this program, who are listening to us. I know 31st March is a tough day to be in, and many of us, as Chitleji was saying, are trying our best to upload the income tax return. This committee, the Direct Tax Committee, has been one of the frontline committees of the Institute. And you see, the pre-budget memorandum that we submit, the post-budget memorandum that we submit, are looked into with great deal of interest and respect by the government of India. And a lot of research goes on, while developing the pre-budget and the post-budget memorandum that we submit to the government. So this committee, as Chitleji, the chairman, was saying, is now also embarking on bringing out later a lot of publications on faceless assessments, etc., which to my mind is going to affect the profession immensely. Anuji was requesting Girish Ahuja ji to speak on the impact of faceless assessment in the profession. So that aspect is certainly very, very important. And at the Institute, we are very concerned, or we are trying to respond proactively to the way the practice will change because of the introduction of faceless assessments, not only assessments, but also faceless appeals. In fact, the Act also talks about faceless appeals at the ICAI level also. So simply, we just have to be that much better. We have to update ourselves that much better. You see, our drafting skills has to get better. And you see, once we do that with the kind of ability that we have as chartered accountants, I have no doubt this challenge can be converted into an opportunity by the professionals. Somebody was telling me that the tax audit limit has now been enhanced 44 AB from 5 crores to 10 crores. And he was expressing quite a lot of concern that with this enhancement, what is going to happen. Please note, this enhancement is only in those cases which are 95% digital. So, with this, technological disruption, the profession must get ready to face the challenges of the technological disruption. And Chitleji, Satish Gupta ji, they are working very hard. At the institute, we are trying to develop a software or audit tools which will be available to all professionals across the board so that they can face the challenges of technological disruptions. And with these technological disruptions, you will have this kind of challenges like this 5 crores becoming 10 crores. When the government announced the change in section 139 regarding non-filing of exemption from filing of income tax returns to the senior citizens, those who are 75 years and above, it has been treated as a very welcome move by the SSCs, and I'm sure we'll have this kind of good steps taken by the government. For reopening of assessments. Chitleji was telling us that now earlier it was 6 years, now it becomes 3 years. But the most important is they are trying to say that no more of use of discretion. Use of discretion to the minimum possible extent while you talk about reopening of assessment. So these are changes, and these are changes which are taking us to a different way of thinking. And at the Institute of Chartered Accountants of India, the Direct Tax Committee is working very hard so as to ensure that the profession is in sync with the change in the way of thinking of the government. And then we have learned professionals like Dr. Girish Ahuja, who does not hesitate to share his vast knowledge on the subject with the membership. With these words, I wish the Direct Tax Committee, the Chairman Chitleji, the Vice Chairman Satish Gupta all the very best. I wish all those who are attending this program the very, very happy learning. And needless to mention, I did not wish Dr. Girish Ahuja ji anything except to thank him for having shared his knowledge to generation and generation of chartered accountants and made them more enlightened. So thank you very much for inviting me here. Thank you very much.
Thank you. Thank you, Mr. Vice President, sir. And your words of input were very generous for the committee, and definitely they will keep us encouraging to do worthy things in this particular year. As far as these faceless assessments, etc., are concerned, certain things which are not very much expected are also at times taking place. We are seized of this information, and we have taken it to the appropriate offices, and we are sure that there will not be any thing which is not desirable happening in case of such assessments. As far as today's topic is concerned, that is the changes made in Finance Bill while enacting it into Finance Act 2021. And what a great opportunity that a person who is legend in this field of direct taxes, by reading his books, number of us have qualified as chartered accountants, and his words are taken at par not only by the chartered accountants but also the other side of the table, the Central Board of Direct Taxes, and they also liberally take advice of the person, and he is with us. Before the financial year unfolds tomorrow, we are getting seized of the information what will be the law that will be in operation from tomorrow. Maybe some of the amendments are retroactive, but then most of them would be operative from tomorrow. So may I request Girish Ahuja to enlighten us on the topic. Thank you.
Good evening, friends. Very young and dynamic Vice President of the Institute of Chartered Accountants of India, CA Dr. Devashish Mitra ji, Chairman of the Direct Tax Committee, CA Chandrasekhar Chitle ji, Vice Chairman, of course, Satish Kumar Gupta ji, and very senior Chartered Accountant and Council Member, CA Anuj Goyal ji, ladies and gentlemen. My apology for one thing I just wanted to ask Mr. Chitle. Am I supposed to do only the amendment which have been brought recently, or I have to do the whole income tax, whole finance bill? Or finance
Sir, important topics from finance bill we can cover, but more significantly, changes in finance.
More significantly,
Yes.
the amendments I would like.
Yes.
Very good. So, sir, the first amendment, where you remember Section 2, Clause 11 relating to block of asset, and Section 32(1) relating to depreciation on intangible asset, the explanation to Section 32 also, and then Section 50, 44, there were so many changes which were made. But I mentioned at that particular point of time that although there was a Supreme Court decision, Swim Securities Limited, where you were allowed to take depreciation on goodwill, and we had been taking depreciation on goodwill, and suddenly one moment they have said now no more depreciation on goodwill or profession. Even profession was not there earlier. I had a talk with them. They said the point is the very big companies are doing amalgamations and showing lot of amount of goodwill as purchase value and then claiming depreciation on that at the rate of 25% because it is a part of the block of asset. I said, yes, there may be some few companies which may be doing in amalgamation, but what about the others? If there is a slum sale or anything else of that nature, we are going to put us into a lot of difficulty. But now they have not agreed. Okay. But at that time, I told them, well, if I have already charged depreciation on that, and that goodwill is already part of the block of intangible asset. Now, since it is already a part of the intangible asset, how will we take out the amount of the return on value of the goodwill? Because you have not shown any provision for that. So therefore, now let me tell you, bill was presented on 1st of February, no doubt. Later on, these amendments are called government amendments. These are the amendments are known as government amendment. Government moves the amendment during the passing of the bill, which are put to vote. And once they are put to vote and they are passed, then they are incorporated in the finance bill 2021. Because 1st February was a different story. These are the government amendment which are brought. So they have brought a change now in section 43, subsection clause 6. What is this 43(6)? Actually, it talks about how to determine the return on value of the block. The return on value of the block, we have the block for tangible asset, we have a block for intangible asset. So block for intangible asset, you know that Satish ji, the depreciation charge on that intangible asset is 25%. The goodwill was also part of the intangible asset. Now, since in future you are not allowed, you are not there this year, you are not going to allow the goodwill, depreciation on goodwill. How will we take out from the block of that intangible asset, which is carrying a rate of depreciation at the rate of 25%? Now they have brought the amendment. I told them they were not given the message. Now they have brought the amendment saying that there is a goodwill which you have purchased and we have charged the depreciation in that particular block. Wait a minute now. Think that there is only goodwill and it is only part of, there is only one block which only contains goodwill, nothing else. Charge depreciation on that at the rate of 25%. Well, there are two things. If the goodwill was purchased before 1988 and 89, at that time there was no concept of block of asset. At that time there was no concept of block of asset. So if it is before 88, 89, up to 88, 89, you are charging depreciation individually. Thereafter it was put into the block, you are charging depreciation in a block. Now they have said that if it is part of the block, take a goodwill as a separate part of the block. It is the only asset in the block. Charge depreciation 25% and calculate the return on value, assuming the goodwill was the only asset in that block, and you calculate the return value today. And that return on value should be deducted from the total return on value of that block. I give you an example. Suppose return on value of the block of intangible asset is, let's say, 1 crore. Return on value of the block of asset, which also has goodwill in it, 1 crore. Now, suppose you had bought goodwill for 50 lakh at particular point of time. we will see that what is the depreciation charge on that 50 lakh till today, thinking that it is the only asset in the block. So we will charge on the depreciation 50 lakh, keep on charging separately on a work note piece of paper that this was the amount. Now depreciation charge till today at the rate of 25% by written down value method. From 50 lakh, it has come down to 24 lakh, let's say. It has come down to 24 lakh. This 24 lakh will be deducted from the block. And the block will be, then you will charge depreciation. Suppose the block value is 2 lakh, I told you 1 crore. So 25 lakh is the value of this goodwill after charging depreciation till due date by assuming that it is the only asset in the block. So we will deduct from 1 crore 25 lakh and depreciation in future will be charged on 75 lakh. But suppose the written down value of the individual asset goodwill is more than 1 crore and we have a block of 1 crore only written down value, then that written down value of that block will become zero. That will become zero. And the balance will be taken to, of course, section 50 for short-term capital gain. So what I'm trying to explain, where if your block has goodwill on which you have already charged depreciation in the past, you will have to work out by assuming that was the only asset in the block and you are charging depreciation at the rate of 20% and calculate the written down value after charging depreciation on the basis of written down value method. And the amount which is there will be deducted from the value of the block, written down value of the block, and the balance value you will be start charging depreciation in future. But I've told you, if the written down value of the block is 1 crore and written down value of the goodwill is 1 crore 20 lakh, then written down value of that will become zero and 20 lakh will go to the section 50 for charging what you call capital. Yeah. This is what I wanted to different story altogether, which I want to tell you, because that capital gain will not happen today. Whenever you sell the goodwill, that time it will be a capital. It will not happen today. I'm coming to the next point. This is the amendment which has been brought by bringing section 43.6. Sir, Chitle Saab, I'm going to talk to you something very different. You will try to understand what kind of a law they have brought. I don't know what kind of innovation they have brought. There is section 9B, which is section 6 to what you call 5, 6, 7, 8, 9 talks about residential status, and section 9 talks about deemed to accrue or rise in India or deemed to accrue. Now they have introduced a one thing like 9B. Try to understand the language of the 9B. I'll have to give you many examples. First, I'm taking 9B. What is it saying? It's saying, before I talk about 9B, I'm giving you certain points. One is specified person, meaning of specified person. Second, meaning of the specified entity. And third is meaning of the reconstitution. Before I start section 9B, let me explain to you section 9B. Specified person means the partner of a firm or the member of the AOP or BOI, whether incorporated or not, but excluding company and cooperative society. So partner and member will be called specified person. Specified entity means a firm which includes LLP, no doubt, firm and AOP or BOI, whether incorporated or not. That is called as specified entity. They have simplified it. Specified entity consists of AOP and BOI and firm, and specified person is the partner of a firm, member of AOP, BOI. Then third is reconstitution. Reconstitution of the specified entity. They have explained what is reconstitution. In the reconstitution, they have said reconstitution can be of the following type. Number one, there is a retirement to one or more than one per person ceases to exist, ceases to remain in the firm or AOP. That means there is a retirement of one or more than one partner or a member, but the firm continues with the remaining members. So it is called as retirement, where one or more than one member retire from the firm, but they cease to be the partner of the firm or member of the AOP, but the firm continues. Second case. The second case is there is the admission of a partner there is the admission of one or more than one partner, but at least one or more than one partner also exists. The old partner also exists. So admission means you are bringing the partner in, but there are already one or more than one partner already in. So that is also called reconstitution. Third reconstitution is no retirement, no admission, only adjustment between the partners. The adjustment may be of the profit sharing ratio. There may be a profit sharing ratio of 25, 25, 25, 4 partners. Now what they have done, they have changed the profit ratio from 40%, 30%, 20%, 10%. So sharing of, this is called also reconstitution. That is, there is a reconstitution amongst the partners, sharing of profit with them. Now I'm coming to that. First I have told you this. Now they have said where a specified person, meaning thereby partner or a member, receives during the previous year, please note the word, any capital asset or stock in trade. Please note the word, any capital asset or stock in trade from the specified entity. You know what is a specified entity. You receive any capital asset or stock in trade in connection with the dissolution or reconstitution of the specified entity. What has happened? There is a specified entity. You have received from that specified entity some capital asset. Please note the word capital. I have not used the word money. Capital asset and or stock in trade or both. Who has received? The partner has received from this firm a share, what you call capital asset or stock in trade. Stock in trade or capital. During what time? At the time of dissolution, in connection with dissolution or reconstitution. Then the specified entity shall be deemed to have transferred that asset to the specified person. There is a concept called deemed transfer. And this deemed transfer shall be a transfer of the previous year in which the specified person receives that capital asset or stock in trade. Let me explain you this point first. There is a retirement of a partner. He is given some capital asset as well as stock in trade at the time of retirement. I'm taking retirement. Dissolution I take little later. At the time of retirement. The law says this will be he receives the asset. They said this will be a deemed transfer under section 9B. Deemed transfer in the hands of specified entity, that is the partner. Which year deemed transfer? In the year in which that capital asset or stock in trade, as the case may be, or the both are received by the specified person, that is the registered partner. Clear, sir? Now then they have used the second point, that for this purpose, whenever there is a deemed transfer, by giving the capital asset and the stock in trade, it will be deemed to be an income. That deemed transfer, the profit or gain arising from the deemed transfer shall be the deemed to be income of the specified person, that is the partner, a specified entity, that is firm. What will happen? When the firm gives asset as well as stock in trade, if there is a profit or gain from that asset, that will be treated as deemed income. Deemed income in whose hands? In the hands of the specified entity, that is partnership firm. And second point says, and it will be chargeable to income tax as the provisions of the capital gain as well as provisions of profit or gain from business and profession. Let me give you an example, sir. Try to understand. Suppose a partner retires. The firm gives him one land as well as the firm gives him stock in trade. Land and stock in trade, or building and stock in trade. Building or land is a capital asset. There is a stock in trade which is not a capital asset. You have got it. They say you will have to calculate the capital gain. In the hands of whom? The firm. How would you calculate capital gain and then business income also? They say first calculate capital gain under section 45(1). You have it is a deemed transfer of an asset by the firm to the partner. So capital gain you will calculate the consideration price in this case shall be the market value of that land or building, market value of that capital asset, that is the consideration price. And you will deduct the cost of acquisition, cost of improvement if it is a short-term capital gain, or index cost of acquisition and index cost of improvement if it is a long-term capital gain. Who will pay tax, sir? Firm will pay tax. Although this is the firm is distributing the capital asset, but 9B does not talk about the taxability. 9B talks about that it is a deemed transfer and it is a deemed income. But where will it be taxed? Under the normal provision of section 45(1), consideration price being the fair market value minus the cost of acquisition or cost of improvement. Second, there will be also business income, which will be taxable under section 28. Suppose the stock in trade, the market value of the stock in trade is, let's say, 1.5 crore, and it was the cost of acquisition of that stock in trade for, let's say, 1 crore 10 lakh. Then 40 lakh will be treated as a business income in the hands of the firm. In the hands of the firm, taxable under section 28. Are you noticing my point, sir? There are two gains. One for capital asset given, which is 45(1), another for stock in trade given, which will be under section 28. And thirdly, when stock in trade will be given, there will be a problem of GST also. GST, of course, when it is a deemed transfer, you will be charging GST also on that, and whether that person who is going to get that will get the credit of input credit. If it is not doing business, then he is not going to get the credit of that input also. So my point is, this is one part. This is one part. Wait a minute. Now I'm coming to 45(4). Try to understand now. Wait a minute. 44(4) says, notwithstanding anything contained under 45(1). Notwithstanding anything contained in section 45(1). If a specified person, you know that, that's a partner, receives during the previous year any money, please note the word money, or capital asset, please note the word capital asset, here stock in trade is not there, money or capital asset or both, from the specified entity, then the profit or gain from that shall be taxable in the hands of the specified entity. Try to understand. There is a retirement. This is in connection with the reconstitution. Here dissolution is not there. There is a reconstitution. You have given asset to the partner and you have given the money to the partner. First thing, if you have given asset to the partner, 9B read with 45(1), that's it is already taxed. Now there is a double taxation. Saying that in 45(4), since it is a retirement and you have got asset as well as money, you will calculate the capital gain in the following manner. How will you calculate the capital gain? A is equal to B plus C minus D. A is the capital gain from this transaction. Let us keep it separate. B means value of money. C means the fair market value of that asset. Minus D, the balance of the capital outstanding in the books. That is D. And the difference will be capital gain. The double tax. Sir, double tax. First, you have already taxed the firm. When you are taxing the firm, but there the word money is not there. There the word is capital asset. So capital asset of 2 crore, I have given at market value was 4 crore. Let's say I have already paid tax under 45(1), but the firm will pay because they have given at the time of reconstitution, consideration price minus index cost will be a capital gain in the hands of the firm. And now there is a second capital gain because the partner is receiving more than the capital. Let's say his capital is 2 crore 40 lakh. He has received money 1 crore and asset market value of asset 4 crore. So 5 crore minus 2 crore 40 lakh, 2 crore 60 lakh will be taxable in the hands of the firm also. So double tax. Same transaction, one, but here tax is only for asset, not for money, only for asset. Let me give you an example. One by one, one has to understand. 99% it is not possible to understand in one go. So I'll be giving many examples to explain to you. First, I'm taking an example. Simply money is given at the time of retirement to the partner. Money is given, only money at the time of retirement. We will ask a question. Is money more than the capital outstanding? If the money more than the capital outstanding, there is a capital gain. If the money given is equal to the capital, then there is no capital gain. Suppose my capital in the firm was 2 crore. I'm given 2 crore, no capital gain. I'm given 1 crore 90 lakh, no capital gain. I'm given 2 crore 70 lakh. So 2 crore 70 lakh means value of money minus the capital. 2 crore 70 lakh will be liable to be taxed under the head capital gain under section 45(4) in the hands of the specified entity. Please note the word, in the hands of the specified entity and not in the hands of the recipient. Not in the hands of the recipient. Specified entity. That means the tax is paid by the specified entity on behalf of the recipient. So, sir, have you understood? Only money received, 2 crore 70 lakh minus my capital, 2 crore 40 lakh, 30 crore capital gain, taxable in the hands of the firm. Second case, no money is received at the time of only asset is received. My capital is, let's say, 2 crore 40 lakh. I've received a capital asset at the time of retirement, and the market value of the capital asset is 4 crore. So 4 crore minus 2 crore 40 lakh, sir. My capital 2 crore 40 lakh, 4 crore minus 2 crore 40 lakh, 1 crore 60 lakh will be taxable under section 45 subsection 4 in the hands of the firm. And now come to 9B, read with 45(1). In 9B, I have received the capital asset. This will be treated as deemed transfer in the hands of the firm. And 45(1) will come into picture, and in 45(1) what will happen? Consideration price 4 crore and minus index cost of the asset. Minus index cost of the asset if it is long term, or cost of the asset, and then it will be either short term capital gain or long term capital gain. Are you noticing my point? Are you, sir, noticing my point? What I am trying to explain, that here in this case there are two types. One gain is under 45(1). Under 45(1), how are we calculating? Market value 4 crore minus cost of acquisition or index cost of acquisition. This is 45(1). Then we are going to 45(4). How do we calculate? Market value of the asset 4 crore minus my capital. The difference is the capital gain. Are you understanding, sir? Example. Is it clear, sir? Chitle sir, what I am trying to explain, again I repeat for everyone.
Yes,
repeating again. My capital in the firm is 2 crore 40 lakh. I am given asset at the time of retirement. The value of the market value of the asset is 4 crore. So first 45(4). 4 crore minus 2 lakh 30 lakh, what is very capital, 1 crore 70 lakh, there will be a capital gain, and they have not told whether it will be long term or short term. They say we will tell you in the due course of time. In section 2 clause 42A, definition of short term capital asset, and there I will tell you. The power is given there, we will do that. But 4 crore minus 2 crore 30 lakh, 1 crore 70 lakh, the tax will have to be paid by the firm under section 45(4). Now I'm come to 9B. Since there is a retirement, it is a deemed transfer. Since it is a deemed transfer, there will be a capital gain under 45(1). How do I calculate capital gain in 45(1)? 4 crore is the consideration price minus the cost of that asset or the index cost. This is going to happen. I give you a third example, very complicated example. Try to understand that. Sir, 45(4) and 9B both will be applicable only when it is a retirement. It is a reconstitution. In the case of dissolution, 45(4) is not there. In the case of dissolution, 45(4) is not there. It is only 9B read with 45(1). But if there is a retirement, if there is a reconstitution, 45(4) will come into picture. Let me give the example. Suppose my capital is 3 crore in the books. 3 crore. I am given three things. 1 crore cash, that is money. 3 crore value of the asset, market value of the asset. 4 crore. And 1 crore 20 lakh is the market value of stock. Market value of stock. Now wait a minute now. When I go to 45.4, the stock will be ignored. When I go to 45.4, stock will be ignored. There only two things will be taken. One money, 1 crore, and the other is asset, let's say 3 crore, 4 crore minus my capital. We will not talk about stock here. Then we will come to 9.1. In 9 section, 9B read with 45.1, there money will be ignored. Money will not be taken. What will be taken? The value of the asset 4 crore plus value of the 1.20 lakh, the stock. We will calculate two gains there. One is capital gain, 4 crore minus cost. And another is business income, 1 crore 20 lakh minus its cost. Sir, could you understand? It is really a difficult proposition. There should be many questions. But wait a minute. At the time of dissolution, 45.4 will not be applicable. Only 9B read with 45.1 and 28. 9B case, if there is a dissolution, 45.4 will not be there. 45.4 is only for reconstitution. So 44 there, what we will take? Fair market value of the asset minus the cost, capital gain. Fair market value of the stock minus the cost, business income at the time of dissolution. But at the time of reconstitution, as far as capital asset is concerned, it is there on both sides, even for 45.4 as well as 9B. As far as money is concerned, it is not there on both sides. It is only in 45.4. As far as stock is concerned, it is only there in 9B, read with 28, and it is not in 45.4. Clear, sir? And one thing they have said, try to understand, sir. Under 45.4, suppose I have given asset plus money worth 5 crore. My capital was 2 crore 30 lakh. Sir, 2 crore 70 lakh capital gain tax is paid. Am I right, sir? 2 crore 70 lakh. But that 2 crore 70 lakh will be treated as cost of acquisition for future purposes of the firm. 48 section, they have incorporated under 48 that this 2,70,000 extra on which you have paid capital gain tax will be treated as a part of the cost of the asset of the firm in a prescribed manner. They will tell you how to allocate this capital gain to the cost of the various assets. They have not yet took. Very surprising. You are charging tax today, but you are giving the benefit of cost of acquisition at a future date when I sell that asset. Are you getting my point? Sir, surprised. What kind of a law? They say we are simplifying the law. Is it simplification? Even I took about 6 hours to understand the law. Because the best thing is, if you want to understand, under section 45 subsection 4, there is a clause, explanation number 2. And explanation number 2 says that the provisions of section 44 shall be applicable in addition to the provisions of 9B. In addition to the provisions of 9B. I could understand only from that explanation, and I have given you these examples. I'm really sorry, but it is a very complicated type of a thing. Yes, if I take whatever was my due, no tax, no tax. And if there is a profit sharing, and in profit sharing we have not given anything, the firm has not given anything to anyone, then also no tax. Profit sharing, no tax. If we have changed, reconstituted amongst the partners, but nothing is paid by the firm to any partner, no problem. Then it remains the same. No problem, no section 9.4, no section 45 or 20. So this is what is I wanted to tell you, very, very important amendment which has put us lot of difficulty. Now second point. Sir, they brought a law that contribution by the employee to the recognized provident fund, if it exceeds 2,50,000 in a year, then the interest on the amount exceeding 2,50,000 shall be taxable on accrual basis in a method to be prescribed. What have they said? Suppose I contribute 4 lakh to the provident fund, my employee contribution, 4 lakh. Although I am going to get deduction of only 1,50,000 under 80C, but the benefit of contributing 4 lakh by me is that whatever the interest I am going to receive on that 4 lakh is going to be exempt, is fully exempt. But wait here. Now interest up to 2,50,000 will be exempt, and whatever interest you receive above 2.50 will be taxable in my hands, in the method to be prescribed. Now this was 250. Now what they have done, provided further that they have introduced one more proviso, that where there is no employer's contribution, but there is an employee contribution, but no employer contribution at all, then in that case, this 2,50,000 shall be substituted by rupees 5 lakh. Sir, this is the benefit which has been given to the government employees or the semi-government employees. In the case of a government, there is no employer contribution to Provident Fund. There is only GPF, Government Provident Fund, and employee contribute. Now, under the earlier law, about 2,50,000 they were supposed to pay interest. Now they can contribute up to 5 lakh rupees, the government employee or the employees of the certain organization where there is no employer contribution, up to 5 lakh, no interest taxable. If they contribute more than 5 lakh, then the amount of interest on amount exceeding 5 lakh, that will be taxable. So this is charity begins at home. This is charity begins at home. They started taking the benefit themselves because they have a power to do anything they like it. What kind of a law is this? Employer contribution is not there. Simple employee contribution, you can contribute up to 5 lakh. The interest will be totally exempt on that 5 lakh. Or, for my case or for your case, it will be 2. For our case, so there is no other. There is no employee contribution. There is only PPF. And our case, PPF is only 1,50,000. No more than that. We can't contribute more than 1,50,000. Everybody knows, because the bank, the post office or the bank will not take, PPF authority will not take more than 150. But for those employees and employer, if the employee contributes more than 250 and there is the employer contribution, then interest on above 250 taxable. But if there is no employer contribution, interest on amount contributed by the employee exceeding 5 lakh, that will be taxable. So both amendments are there under section 10, 11 and section 12. The one proviso was added. This is the further second proviso which has been added there. Next change, sir. Sir, you were talking about, the Vice President was talking about the limit of 5 crore raised to 10 crore in the case of tax audit. But there was a proviso. The proviso said that 95% of the payment or the receipt should be received or paid in a mode other than cash. So maximum is 5%, the mode other than cash. Now they have added a second proviso. Further provided that the proviso, for the purpose of the above clause, that clause is 95%, 5% in cash. For the purpose of the above clause, if there is a payment or there is a receipt, as the case may be, which is by way of bank draft, by way of a check drawn on a bank or a bank draft, which is not by account paid check, then that amount will be treated as paid in cash or received in cash. What is the meaning of this? That if I receive money through what you call a bearer check or a cross check, or if I make the payment by cross check or cross draft or a bearer check, in that case, it will be treated as payment made in cash. So some people are saying now there is a benefit. The limit has again come down to 1 crore. Because you remember in the current form, when you filed a return, there was an undertaking which was supposed to be given by the assessee that 95% payment is in a mode other than cash and 95% the receipt is in a mode other than cash. This is already there. The form is already there. Now there is another undertaking that no payment has been made in by a check other than an account paid check or by a draft other than account paid draft. Probably the things will become difficult for employer or for the assessee to give that undertaking in the return of income. Point is, I agree there is section 48(3) which talks about that payment of the expense which is claimed as deduction should be by way of account paid check or account paid draft or through electronic clearing system. I agree. But there are people who are misusing it by making a payment of 10,000 each day. Each day. They are doing it. And secondly, those who are covered under 44 AD, when they buy the goods, they can make the payment in cash because under 44 AD, 48.3 is not applicable. So I may be a person, seller of the goods, given to a buyer who is under 44 AD. So he can make the payment in cash to me. So that amount which is paid in cash to me, if it is given by cross check or anything, I will be caught because it will not be covered. So my point is, to a greater extent, now assessee will avoid giving undertaking that the 95% of payment is a mode other than cash. Although the onus is on the department to prove that it is account pay check. But the point is, when the scrutiny comes, they will say, show us that you have made the payment by account pay check and not by what you call. You already remember when you do tax audit under section 269 SS and 269 ST, when the payment is about 20,000, we have to show that it is by account pay check and account pay draft. But we used to put the responsibility on the management. Now, the SSC will be really troubled because he knows that if he's not able to prove, or onus will become on SSC whenever the case comes for scrutiny, that's proof that you have made the payment by account pay check only or account pay draft and not by cross check or bearer check. So that may give us the benefit of having more audits, even if provided it crosses 1 crore and even the turnover is less than 10 crore. Let's see what is going to happen. Next point. That was the mistake which they had committed, because they will never accept that they can also commit a mistake, because when they said that a professional earlier they had written a person who is carrying on a profession referred to in 44AA will be allowed to opt for 44 ADA by assuming his income to be 50% of the total receipt, provided the receipt do not exceed 50 lakh. That 44 ADA was there. But there will be a person. Then they later realized that LLP is supposed to maintain books of account, and 44 ADA there is no need to maintain books of account. So since the SLP are supposed to maintain, they wanted to change it. They wanted to exclude the LLP. So they wanted to put it, they say, a person being, then they copied from 44 AD, person being an individual HUF or firm other than LLP. Then I told them, sir, since when HUF can do profession? I didn't know that HUF can also do profession. This was the news to us, because that was cutting and pasting. From 44 AD, they had picked up and brought it down. Now they have rectified that mistake, that this section is applicable only to the individual or firm other than LLP. The HUF has been deleted. That was a mistake which they had committed. Now they have deleted that point. Next point, sir. Section 50B, slum sale. Earlier amendment which was there was only for section 2 clause 42C, giving the meaning of the slum sale. Earlier the meaning of the slum sale was transfer of an undertaking or a division of undertaking as a result of sale. Please note the word as a result of sale. Then there were so many decisions. As a result of sale, sale is always for money. It cannot be barter. So therefore they said only money if it is there, then 50B is applicable, slum sale is there. Otherwise it is not 50B. Then they changed the law, say the definition this in the bill. They said transfer of undertaking or a division of an undertaking by any means, not as a result of sale, by any means, which will also include barter system or exchange. But now they have introduced one more amendment. The amendment is for slum sale, section 50B, subsection 2. Earlier, when we were making a slum sale, nothing was talked about of the consideration. They said the consideration shall be the lump sum amount which you have received for transfer of a division or undertaking, nothing to do with the market value or anything. 50B used to say lump sum consideration receipt. And then you had to deduct the net worth. The net worth was the cost of the asset, book value of the asset minus the liability, and we used to call it as capital gain if it is held for more than 36 months, if the existence is 36 months more, long term, otherwise short term, no indexation. Now what have they done? Section 50B subsection 2 has been replaced, has been substituted by the new subsection. It says, now the consideration price shall be the fair market value of all the assets. Fair market value will be the consideration price, sir. Now fair market. That means if there is a land, you will have to take 50C, the fair market value. There, you will have to calculate the fair market value for calculating the consideration price. And then when you deduct the net worth, please note, if the net worth consists of goodwill also, if the goodwill has been purchased from previous owner, then it will be deductible. If the goodwill has not been purchased from the previous owner, it will not be part of the net worth. Suppose I created a goodwill. It is not purchased from previous owner. There was a goodwill in my account. Now if I make a sale, earlier I used to take it, all the assets, including the goodwill minus liability. Now they say nothing doing. All the assets, excluding goodwill. Goodwill will be taken only in the net worth if it is purchased from the previous owner. If you have not purchased from the previous owner, if it is self-generated, you will not be taking the value of the goodwill in the net worth. And calculate 50B capital gain on that basis. So the section 50B was changed accordingly. So this is what I wanted to tell you, the change which has taken place under section 50B. The next change. There was a mistake in 139.4 and 139.5. They have reduced the time period for filing a return or belated return or a revised return by 3 months. But the language was wrong. The language was that you can file a belated return within 3 months prior to the end, within 3 months prior to the end of the relevant assessment. The word was wrong. Within 3 months. Now they've used the word that you can file the return or revised return or belated return 3 months prior, before 3 months prior to the end of the relevant assessment. Within has been substituted by the before. The language was wrong. It was giving different meaning. Now they have changed it, but it remains 9 months. Completion of assessment has to be done within 9 months from the within 9 months. And revised return. Revised return or belated return cannot be filed after 31st December of the assessment year. That is before 3 months prior to the end of the relevant assessment year. So that was the language which was a mistake. They have rectified that mistake. There was some mistake about that spouse of the partner in the case of section 5A Portuguese law, community of person. So they missed the word spouse. They've added the word spouse there. The next change. Sir, new law of reassessment has come. You know that, Satish ji, 147, 148, 148A, 159, 149, 150, 151, they've already been changed. Now even such cases will be as per the new law of assessment. In the new law of assessment, there is section 148 where you have to give notice. But you have to give a notice when you have information in your possession. Now they had given under 148A that if you have information in your possession, you will communicate that information to the assessee, give the show cause at that, and then they decide whether that is a genuine information or not. But at the same time, what happened is that if there is a case of a search or a case of a survey or case of requisition, at that time, there is no need for 148A. Simple, that will be treated as deemed information. Now they have included the survey also as deemed information. If there is a survey, they may not give you notice under 148A. They can straight away give you notice under 148 for filing a return of income. There is no need for giving a notice under 148A, an inquiry done under 148A. But they were used the word survey. Now they are excluding two kinds of survey. Survey of TDS and survey of some celebration or marriage ceremony or some function. In the case of survey of TDS and survey of marriage function or ceremony, in that case, it will be 148A will be applicable. That means you will have to give an opportunity of being heard, you have to give a show cause notice, you have to make inquiry, and then only take up the step for 148 and thereafter 147. But if it is a pure case of survey, not related to the TDS, not related to the marriage function, there is no need for 148A. You can directly treat as a deemed information and issue notice under 148 for assessment to be done under 147. So that was the point which they wanted to change, and they have done it. Small change in 115 JB also. That was regarding the dividend of the foreign institutional investor, and sometimes the adjustment on account of secondary adjustment or past year adjustment. They had said the benefit that will not be counted for the purpose of book profit. But they have said, look here, there is a proviso added that if you have taken a credit of that, MAT credit, then that will be counted for the book profit. That is the only point which they have changed in that point also. Next change, sir. Sir, 234F has become superfluous because you know that in 234F there is a fee for late filing of return. The fee, Mr. Satish ji, was that if you file up to 31st December, the fee was 5,000 rupees. And if you file after 31st December, the fee was 10,000 rupees. And in the case the amount does not exceed 5 lakh, the fee was 1,000 rupees. Now, since now you can file the return only up to 31st December, you cannot file after that. So section 234F, that point of 10,000 penalty had become superfluous. So therefore they have modified the section 234F by removing that filing after 31st December. Now they say if you file up to 31st December, the penalty will be the fee. It is not penalty. Sir, there is a difference. Fee has to be paid along with the filing of a return. Penalty was to be initiated. You have to deposit the fee of 5,000 rupees if you file the return by 31st December. However, if the return of income does not exceed 5 lakh, then the fee will be 1,000. That is already there. So what have they done? They have modified 234F because of superfluous that you cannot file return after 31st December. So why have a fee of rupees 10,000 for filing a return after 31st December? So that has been done away with. Another change, 234H, a new fee has been added. It's saying that if you don't link your Aadhaar with the PAN number, you will be liable for fee. There is a difference between penalty and fee. Sir, Satish ji, fee has to be paid along with filing a return of income. You have to deposit the fee. There is no initiation of fee. There the fee they have said will be imposed subject to maximum of rupees 1,000. So 234H has also been introduced for that reason. So that's why I wanted to tell you that 234F and 234H have been changed to that extent. The rest changes are only technical changes which were there under section 10.4D, section 10.4E. There was a change in section 10.23FE, some technical changes because International Financial Center can also be treated as giving benefit of 10.4D, 10.4E. So they have brought it under ATLA for International Financial Center, that is a gift city, and the corresponding amendment has been made under 10.4D, 10.4E, 10FE also. They have added two more sections, but are just yet to be notified. There is section 1048D and 1048E, which have been read that if there is an institution notified by the government, they will be notifying it, an institution for financing the infrastructure and development. In that case, their income will be exempt up to 10 years. A new section 1048D, institution yet to be notified. So far, no institution has been notified, but law has been changed, and there is also 1044E that the Reserve Bank also will notify certain institution for financing the development, for development financing. There also, they have said the income of that institution which is going to be notified, not yet notified, will be exempt for a period of 5 years. So those 1048D, 48E is a future question, or futuristic. Futuristic means once they are notified, their income will be exempt to that extent that they have done in the 1023E or also. So these were the major changes, sir. If you want me to explain any other change which is relevant for the, which is already done, I can repeat those changes which are very, very relevant. These were the major amendments which were brought by the government amendments. But if you want to talk about any issue relating to the finance bill, I'm most welcome. I will take up one by one those also if you want that anything to be done there. Yes, sir.
Yes. Thank you, Giriji, for elucidating the changes brought about in finance bill. Vice President desired to have your comments on this faceless assessments and appeals. As far as particularly faceless appeal before income tax appellate tribunal is concerned, how will it fare? So if you can throw some light in the meanwhile, queries have come, I will ask them thereafter.
I remember we were asked when we were redrafting the Income Tax Act, we were asked that you have to include faceless assessment. At that particular point of time, we told them it is not possible to bring faceless assessment in one go. Let us come by step, but maybe regional level or maybe at the not at the national level, zonal level, regional level, and then finally the national level. But the PM said nothing doing. I have to bring all things on faceless. Now it is not a faceless assessment. You know that it is going to be faceless appeal. It is also going to be faceless wait and watch. It is going to be faceless rectification. You wait and watch. It is going to be faceless DRP. You go wait and watch. It is going to be faceless 263 also. Everything is going to be faceless. This is what they have said. But there had been certain problems which have been told to them that there are certain officers who are contacting the chartered accountant that we have a particular case with us that if you want, it can be done. 3-4 persons have been suspended. In the government, officers have been suspended. Even now I have been told by somebody, people are approaching. But let me tell you, these are the teething trouble. Let us accept the faceless assessment. Now the real worth of the chartered accountant will be known. Real worth of the chartered. Earlier though we never used to study because we know we can get the things done. Now nothing doing. You can't get the things done. You have to apply your mind. You have to apply your knowledge. You have to have a flair of writing. You will have to have flair of replying, communication. Let me tell you, real knowledge will now play a beautiful role. I am rather very happy that now every chartered accountant will have to read the law. And not only read, he will have to develop many skills. Skill of drafting, skill of communication. Now they know, I tell you, the chartered accountant can do anything. They have got knowledge, but they were not using the knowledge. They were not studying the law because they knew it that they can get the things done in some other manner. Now the real worth of a chartered accountant is going on. I'm telling you, I'm assuring you, now the value will come. I remember when we started, sir, Chitle Saab, these CP hours, everybody started criticizing, what is this CP hour? What is this? You are wasting our time. 5 years, 6 years, 7 years, whatever is the time when it may be. Remember that time. Now everybody is saying that nothing like CP hours. So many amendments have taken place. So many amendments and so many seminars are being conducted, and we have learned a lot from these CP hours. I tell you, I also attend many CP hours, not for to get knowledge. Sir, it is very difficult to study yourself. Now you have expert knowledge through the Institute of Chartered Accountant, and the new media also has come, what you call as virtual lectures. I'm telling you, people are happy. People are saying, thank God that Institute started CP hours. Now at least we know we are going to be updated, and they are getting themselves updated. Let me tell you, it is only chartered accountant who could do GST. GST has become successful in this country only because of chartered accountant. Had there been no chartered accountant, GST would not have been successful. So let me tell you, they know the worth of a chartered accountant. Don't worry, they know the worth. But chartered accountant was not showing his worth. He was a most educated and respected person. But the only difficulty was, what was the use of studying the law if you could manage the things the other matter, by other means? Now, no management by other means. Some hanky-panky thing, you cannot avoid corruption 100%. But to a great extent, let me tell you, we will be respected. Now the client will know the real worth of a chartered accountant. How to present that case, how to communicate, how to reply the show cause notice. Now the things will come. And I request in the directors committee to you, sir, have more practical oriented things for faceless assessment. Faceless assessment is now seen the light of the day. It is not going to go, let me tell you. There may be certain hiccups, but those hiccups can be rectified. Let me tell you, the government is very serious. If they get any complaint, they are taking proper action against those officers also, because it is accountability is also very important. Well, you see and let me tell one more thing. Sir, earlier there was a notification for e-assessment. From 1st April, it has been brought in the Income Tax Act, Section 144B. And there earlier the name of the National E-Assessment Center. Now the name will not be National E-Assessment Center. The name has been changed to National Faceless Assessment Center. The Regional E-Assessment Center up to 31st March, up to today. Tomorrow the name will be Regional Faceless Assessment Center. Let the Chartered Accountant read Section 144B. There are some changes in 144B also. Let me tell you, this is going to be, now the Chartered Accountant should feel happy. They are going to have, let me tell you, very good quality of work. Earlier it was not a quality of work. Now that you will have to tell your clients, gone are the days. Now there is a 360-degree profile. The lot of made by the department. Lot of information is coming from the department. You must have noticed today also, they have given notice to the HNI people that you have done this transaction, you have done this transaction, you have done this transaction. What I'm trying to tell you is they have lot of information. And that's why they have brought 148A section. Earlier for reassessment, you had to, they had to have reasons to believe, and they had to give you the reason after filing a return. Now the reason will be told to you. It is on the cards will be placed on the table that these are the income which has escaped assessment. Kindly show cause why this not be taxed under section 148 read with 147. So my point is, it is good. The information, lot of information are percolated. You remember 26AS. Now what is the advantage of 26AS? You can realize now. Earlier never bothered about 26AS. Now you cannot file a return of income unless you properly scrutinize 26AS and incorporate every income where the TDS has been deducted, unless you are carry forwarding the TDS. So my point is, the information under 26AS is also going to be more and more. Even the capital gain, long-term capital gain, short-term capital gain will automatically be pre-filled. You will get information of many things. Wait for the day. So therefore, they never feel disheartened. Be motivated. Now it is the time to test your knowledge, real development of skill. So wait and watch, sir. Whatever are the trouble, you please let us know. You are a directors committee chairman. You have a direct approach to the CBDT. You can always go to them and explain to them. And this government listens, sir. This government listens. They take action immediately. Or if you write to the PM on that, on the PM, what you call, that is immediately passed out to the department, and they have to reply for that also. So my point is, the action is being taken. So don't worry if there are certain reasons that will also be solved, and the difficulty which you are facing, if you tell me also, you yourself can handle. Otherwise, you tell me, I'll see to it that it is taken care of. So that's why I said there's nothing to worry.
Yes.
Only problem is appeal hearing, because that is a jurisdictional function or appeal. That the case is already lying in the High Court. Let's see what is going to happen. That it is our birthright for having a personal hearing. Let's see what is going to happen. But the personal hearing in the case of what you call assessment, they say people will take unnecessarily personal hearing just to know which kind of a person. They had, in what you call, the other day the chairman was telling me, they had one personal hearing on video conference. You could not see the face of the officer. They could see your face. So they have started doing that also. So you will not be able to see who is the person who is talking to you, but they will be able to see you. So they are trying to have the confidentiality, and let me tell you, things will improve and it will be in our interest to go for faceless assessment. वो चला गया जमाना, सर मैं जानता हूं, I know him, I will manage. Question of manage is not there. It is now skill application, which is a knowledge application, which is going to be there. Tell me, sir.
Yes, thank you, sir. And I'm glad to place on record that substantial majority of the professionals are really following path of reading books authored by you and by others and attending this CP hours, studying on their own and representing the cases. Maybe few are black spots, but now with this transparent regime, I think they are put to notice, and you are rightly reminded. I'm sure that whatever things we notice, whatever are hurdles, will definitely represent to the CBDT, and we will also be taking liberal help of your assistance. Rajesh Tibrewal from Sambalpur has sounded us a note of caution that ICAI, rather than representing for extensions, should tell CBDT that please come out with forms of ITR, etc. on 1st of April. Let me tell you that we are already in dialogue with CBDT. The Institute has already presented a letter to the Central Board of Direct Taxes Chairman. I myself have personally met the members, and we have requested that ITR forms and tax audit report forms should come as early as possible. And considering the importance of this particular aspect, we have also offered that ICAI will extend any assistance, any help in order to ensure that these forms are coming in time. So I'm sure that we are taking proactive steps in this behalf.
They will be coming very fast. Have you noticed that the Form 10A, 10AB for charitable trust, which is starting from 1st April, they've already notified. So the returns will also be notified very soon. But the point is, our habit is to file the return only on the last date. That point we will have to change our habits also, sir. That is it. Now today also people are filing return on 31st March. Why couldn't they file 2 days before? 31st March they are filing return. What about 27th March, 25th, 24th, 20th? Why today? Why we are saying that it is not working? This is something very surprising. I fail to understand that why we postpone the thing till the last day. We will have to change our habits also, sir. We'll have to change our habits.
Yes. Yes, sir. And as far as your suggestion about series on drafting, etc. is concerned, we will definitely do so. And our Vice Chairman Satish Gupta already arranged such webinars last year. We will have much more webinars under guidance of Satish Gupta. Sir, there is one question about this reconstitution. In case of reduction of share in profit, there is a reconstitution. So supposing there is reduction on share of profit, A share is increased, B share is reduced, and the person whose share is increased, he directly pays to B. Whether there will be any tax implications.
If it is out of firm transaction, if it is not through the firm, then 56.210 will be applicable. It will be treated as a gift. 56.210 will be becoming applicable unless he is a relative. So whatever transaction routed through the books, that the firm will have to pay tax, not the partner. So if it is a transaction outside the firm's books, the firm has nothing to do with that. If they're doing it outside, then 56.210 will come into picture, let me tell you.
Sir, in case of this payment by one partner to another, if the agreement is made that because of your conceding right to share the profits, I am paying you this amount, whether 56.2 will apply?
Sir, my point is, you are taking a money, you are saying the 56.2 will not be applicable because the 56.2 talks about a movable property, and in the movable property that amount is not there, or 56.2 talks about immovable property, 52 talks about money. When the money is got, what is the consideration for that money? So that point is that money is received for without consideration. The consideration is that he has foregone. The foregone is in the firm, not in the outside. If he has foregone, the firm should get paid that issue. It should be routed through the firm. if you are foregoing a share in the firm, that should be rooted in the firm itself. Why outside the firm? Why outside the firm? Because the reconstitution is in the firm. Your share was 40%. You have brought down to 10%. For that, you have taken the money. That money should be taken in the firm. The firm should pay the money. The firm should pay the tax, not the individual. Not the individual.
Even if it is taken from individual.
Sir, that point is your private consideration, private thing.
Right.
That has nothing to do with the firm. Then how the firm is connected with that? The
Firm
does
is not connected. Yes.
Reconstitution is only in the firm. Already you are not out. You are not doing outside. You are doing in the firm. The reconstitution is done in the firm, and the firm pays the money. They have changed the money, exchanged the money. That point will be taken. Outside wala, their transaction will not be allowed.
Yes. There is another aspect of this relating to revaluation of assets.
Not
you
allowed.
can throw some
They have
light.
already said revaluation of
It will be
asset not
excluded.
allowed. Self-generated asset not allowed. Goodwill also not allowed if it is the cost is nil.
Yes, so from the amount of capital that these amounts will be excluded.
Yeah.
Yes. Then one question is, what happens if the partner expires?
So dissolution. It's not a retirement. It is a,
No, there are-
if they are more than one, if they are already more, three partner, one expires, absolutely no problem. Then it is a case of retirement. My point is, when there is a death, it is a dissolution unless and until you reconstitute their death. Then there is no problem. Then you give the money. During the dissolution, a person who retires up to the date of death, the legal heir gets the payment up to the date of death. So up to the date of death is included. Up to the date of death is the money of the partner. That goes to legal heir. Up to the date of death, it is already covered there.
There is one more question that the reference is made to the balance appearing in capital account. So whether it will also include balance appearing in current account and balance
They have said
appearing
capital account of any nature. They have already included of any nature. So even current account, capital, all account. These fixed capital current account are only for accountancy purposes. In income tax, there is nothing like fixed account, fixed capital or current account. That is all capital. In income tax, it is not like that. It is only accountancy we learn. That there is a fixed capital, there is a fluctuating capital, the current, but no, not in income tax. Any kind of capital.
And if loan is paid by the partner,
Loan is not a capital.
loan
is not
will
a
be
capital.
excluded. Yes.
Loan is not a capital. Current account is a capital.
Sir, participant want to throw light on this. Can you explain section 194Q vis-a-vis section 206C?
Let me tell you.
Yeah.
Sir, last year, section 206C1H came from 1st of October 2020, which said every seller of the goods at the time of receiving the payment for the sale of goods exceeding 75 lakh said have to collect, exceeding 50 lakh, 50 lakh will have to collect TCS at the rate of 0.1%. There the definition was given of the seller. The definition of the seller was his turnover of the preceding previous year should exceed 10 crore. So seller turnover more than 10 crore, the buyer turnover has no meaning. So if he was receiving payment exceeding 50 lakh from 1st of October, the amount exceeding 50 lakh, he was supposed to collect the TCS at the rate of 0.1%. Now they have brought 194Q. Every buyer of the goods, now it is buyer of the goods, who has purchased goods or made payment exceeding 50 lakh, then he will have to deduct the TDS at the time of making the payment or at the time of credit of the value of the goods, whichever is earlier, at the rate of 0.1%. Wait a minute, sir. Here the definition of a buyer has been given. The turnover of the buyer in the preceding previous year should exceed 10 crore. Now wait a watch. If the turnover of the buyer exceeds 10 crore, section 194Q will be applicable, 206C1H will not be applicable. If the turnover of the buyer exceeds 10 crore in the preceding previous year. In the current year, section 194 will be applicable, but the applicability will be from 1st of July 21 till 30th June 21, 206C1H will be applicable. Because there the seller turnover is more than 10 crore, then wait a minute, sir. If the seller turnover is more than 10 crore and buyer turnover is less than 10 crore, 206C1H will be applicable. If the buyer turnover is more than 10 crore and seller turnover is also more than 10 crore, seller turnover, the buyer turnover of the preceding year more than 10 crore, seller also more than 10 crore. In this case, 194Q will be applicable. 206C1H will not be applicable, but 206C1H will be applicable only up to 30th June 2020. After that, it will be 194Q which will be applicable. And now next point. Seller turnover more than 10, buyer turnover less than 10 crore. 206C1H will be applicable. 206C1H will be applicable. Buyer turnover more than 10 crore. We are not bothered about the seller turnover. 194Q. If the turnover of both buyer and seller is less than 10 crore, no section is applicable. Neither 194Q nor 206C1H. So you have to see the turnover of buyer. If the turnover of the buyer for the preceding previous year more than 10 crore, please note 194Q will be applicable, 206C1H will not be applicable. 206C1H will be applicable first up to 30th June, and secondly, if the buyer turnover is less than 10 crore and seller turnover is more than 10 crore and the amount received is more than 50 lakh. In 206C1H, it is amount received. In 194Q, it is not the amount paid. It is also the value of the goods, whichever is earlier. That is the point.
One query. Yes, please.
Sir, one query is there of CA MG Raman. Besides IT return form being made available on 1st of April, the form should not be changed afterwards during the year. So this is the concern.
Sir, let me tell you, very rarely it happens. Very rarely it happens. But what has happened is, new law has come. The new law has come, which is applicable also from assessment year 21-22. If it is applicable 22-23, there is no problem. By the next year happens. Now, certain law like this partnership law, it has become applicable from assessment year 21-22, previous year 2021. Now they have to prescribe certain things. When they have to prescribe certain things, how to calculate, so that's why they will have to change it. Had there been no amendment from assessment year 21-22, there would not have been difficulty. But the difficulty is there are certain amendments which have been made applicable from 21-22 to avoid the tax planning. And that's why sometimes the form has to be changed when the new rule comes in. That's why the form has to be changed when new rule comes. That is the only reason.
Sir,
Yes.
Chairman, sir, I would like to ask something.
Please, Satish bhai.
Also, sir, there are some queries on the taxation of charitable trust part, and the people are facing some problem in regards to registration with some other authorities. Whether it will cover only when the trust is registered with the sub-registrar, it is sufficient, or the trust has to go to registration with the Devasthan Vibhag or
They have said you
charitable
have to
commissioner.
submit the certified copy of the society, if it is society registered under Society Registration Act, or you have to submit the copy of the Section 8 company, the certified copy, or if you are a trust, you are registered with the trust, whatever you are, wherever authority you are registered, you will have to give that certificate. Otherwise, unregistered, they are not going to give you the benefit. There are only three methods of having a trust. One is Section Section 8 company. The second is the society registered under the Society Registration Act. For that, there is a registrar of firm and a society. You have to go there, get it registered. And third, of course, is trust. You have to get yourself registered under Registration Act. That is Registration Act 1908. Registration, not under Trust Act. There is no Trust Act for charitable. Not under the Trust Act. Registration Act 1908. You have to pay stamp duty for registration of your trust. That is the point.
That is okay. So it means sub-register, if registered with sub-register, then it is okay. And second thing, sir, in regards to trust also, because they have changed the procedure of renewal, but in one case when 12AA applied on January 19,
Whatever will be
and
pending on
rejected.
31st, whatever will be pending on 31st
But
March,
in
has not
the
been
case
given.
when
I'll tell you.
when ITAT has restored the issue, ITAT has restored the issue and pending with the CIT exemption, they have not taken any course of action on the restoration. Then whether the trust should go for the fresh registration or for renewal, sir.
Sir, since they have been asked to, they don't have a registration number. They don't have a registration. They will have to go to the registrar, to the commissioner of income tax or commissioner of exemption or principal chief commissioner of exemption to get it rectified, because the time there is up to 30th June. So they should get it done and get the registration under old and then apply for renewal. Then apply for re-approval. It is re-registration. It is re-registration, re-approval. So first they should go there, get the direction, whatever given by the ITAT to be implemented to get the certificate of registration, and thereafter they should apply for re-registration or re-approval. They will have to be. They will have to give this, otherwise they will have to meet the person concerned to tell them that we have to go for re-approval or re-registration, and there is a direction from the ITAT to give us registration. So please do that first.
Got it, sir.
Oh,
Sir,
yeah.
I need your larger view that what is the future of new reassessment scheme, sir. Do you see that it is in the interest of profession?
Sir, let me tell you, sir, there is beneficial, this scheme is beneficial for such cases, but this scheme is not beneficial for the normal reassessment cases. Now, although it is a period of 3 years, but they have extended it 7 year more also for the cases where the income escaped assessment is 50 lakh or more. Now the point is, if the income escaped assessment is 50 lakh or more, that has to be decided. Please note, not from your books. They should have the information with them. They should have the documents with them. They should have the evidence with them, and they should represent an asset. And now they have made the amendment. Asset here means, they have said asset here means land, building, shares, share certificate, loans also is an asset, and money. So they have amended section 149 saying that when you are saying that the documentary evidence or there should be information in their possession on the basis of the books of account, they say it should represent asset. Now they have defined what is an asset, and because of that asset, now there will be more cases of 50 lakh exception.
Sir, just there is an information that due date for linking Aadhaar and PAN has been extended to 30th of June 2021.
So that penalty of 234H will not be applicable in the meantime. It will be applicable only after 30th June.
Yes.
Great, sir.
Penalty nahi hai, fee.
Sir, just now you mentioned that as far as this reconstitution of firms is concerned, the amendment is retroactive. So what is the bearing on interest under section 234C if advance tax installments are not, earlier 3 installments are not paid?
In the case of a capital gain, you already have a 234C where they have already told you that if the capital gain happens after a particular date, then you can deposit the advance tax after that date in the balance number of installments. So if they have done something, now if I have done before that, and now they are caught under because they wanted that people may not do it from back date. If they had allowed it done, they would have done it from back date. Now there is no back date problem is not there. You will have to pay 234C. The only thing is the capital gain, the 234 will be applicable only after the date of capital gain. So you can. That's all. Otherwise, there will be a problem.
No, can it be claimed that I was not aware when the retirement took place in June 2020, some capital gain had arisen in June 2020, but law was not there to
that time there was no capital gain. There was no income.
Yes. So now,
at that time there was no, sir, 145.4 was already there. That was asset given in kind. That was already there. It was only the case of money. And it is the case of, there was already a dispute about retirement, whether retirement was included or not under 45.4. Now they have specifically said retirement is under 45.4, whereas dissolution or retirement is also there under 9B. So my point is, this you can always write to them, give them some concession of the interest part, because this was not for no fault of theirs. And they may, although 234 ABC, the question does not arise, C, so they may give you benefit of 234C. AB, the benefit cannot be given because 31st March is the last day. Make the payment.
Sir, after removal of settlement commission, sir, Ahuja sir, after removal of settlement commission, sir, how do you see the profession?
Sir, dispute resolution committee. I tell you, sir. This is, I tell you. Settlement commission was only for settlement. आपको भी पता है, मुझे भी पता था. We used to settle. I am very clear in that. Now there is going to be dispute resolution committee. So far, it is a start. Only cases up to 10 lakh variation and 50 lakh return. This is committee. We have recommended that there should be outsider also in that committee. It's not the department people. There will be expert people called, maybe chartered accountant called with a member of that committee and draft order will be prepared. And from their draft order, you will be told that look here, pay the tax or you will present your case. And you will be saving lot of time in the form of penalty and interest also. So it is going to be a very good proposal, provided they accept that outsider will also be part of that committee. I'm telling you, lot of scope will be there. And you will see many things getting settled there, and then you may not have to go there beyond that. But settlement commission, they know what was happening in settlement commission. I don't want to say anything.
Good.
Sir, as a corollary to this, now settlement applications filed from post 1st February till 31st of March because of court, what will be the fate of those applications?
Nothing. Only the case which was already admitted, that is gone to the board, not to any other. That is also not there. No, sir, no. They said only the case which is pending with them for decision. Then only. No fresh admission at all. They will be sent back.
Yes. There are two issues about tax audit. Now, in one case, supposing there is a person from whom about 10% of the sales, the goods have been sold to him, and from the same party there are purchases. So against this sales, if the purchases, receivables and payables are knocked out, then how it will be considered for the purpose of that 95%? And
not in a form other than cash. That is the point is there. It is not cash. That
it is not cash.
That they have not said. They said only thing is now they have used about check, but they have not used anything else. So if there is a set off, they have not said anything but that. They have not said anything for that. That will have to be not treated as a payment in cash, according to me. Let me sir, you can always put up this in the to the department to give the answer. But normally you don't give the answer. Problem is this.
But I think that benevolent case law available for 269 SST, etc. will not be available here, because there the object was different. Here the object is different.
Correct.
Yes. Then for non-filers, there is higher rate of TDS. So if you can throw light on that, how to identify.
206AB and 206CCA. Now what has happened is, there are people who have got the tax deducted. Let's say what you call contractors. The tax TDS deducted in the case of contractor is either 1% or 2%. But they don't file their return. Then giving the furniture on rent, giving the machinery on rent, the rate of TDS is only 2%. And they do not file a return at all. Now what they have said, that if you do not file a return for the last 2 years, have not filed a return, and the tax deducted at source or collectible at source was 50,000 or more, in that case, you will have to deduct the tax at twice the rate applicable. If the rate is 10%, you deduct at 20%. If the rate is 5%, deduct 10%. If the rate is 1%, minimum is 5%. You deduct. Somebody was asking me, sir, how do I know that he has not filed a return for the last 2 years or his TDS deducted is 50,000 rupees or more? Sir, you will be given you will be given access to the site where you can put his PAN number, and once you put your PAN number, it will come with up there whether he has filed return for last 2 years or not. So don't worry, you will be given a link to that site. Put a PAN number of that gentleman, you will come to know whether he has filed return for 2 years or not. Similar provision is for TCS, the rate is twice. Similar provision. Because they are not filing return of income, all the TDS or TCS have been deducted or collected, but they said two conditions. One, last 2 years you have not filed a return. Two, the TDS deducted per year or TCS per year is 50,000 or more. That is the point.
So in this case, not filing of return will be read qua requirement to file the return. So if the person's income is below, say, 2,50,000 in 1 year, and therefore he was not required to file the return, in that case,
they said you were TDS क्यों कटा है? You were supposed to file a return. You are required to file return. If you are not required, then there is no problem. You are required to file return.
No, two cases. Yes, I understand. Only in case if it is the first year of starting of business, maybe in earlier year he was not required to file the return.
So they have not said anything. They have said minimum TDS deducted 50,000. So where is the question of TDS of the 50,000 rupees?
Yes.
There are two conditions.
Yeah. So as far as this reconstitution is concerned, you explained about 9B and 45. Members want that if you give a couple of more examples, it will be carried home more appropriately.
Let me give a very complicated example first. No, first thing is, 45.4 is applicable only in case of reconstitution. When there is a reconstitution, 45.4 plus 45 plus 9B read with 45.1 will be applicable. If only dissolution, 45.4 is not there. If only dissolution 45.4 is not there, it is only 9B read with 45.1. Next point. In 9B, if the money is received, 45B, 9B is not applicable. 9B is applicable only when asset is received or any stock in trade is received. Third thing, I take a case of reconstitution. My capital, Satish ji, in the business is, let's say, 3 crore. 3 crore. If I've given money 4 crore, I will be the firm will be liable to pay tax on 1 crore under section 45.4. 9B is not applicable because 9B is not for money. 9B is not for money. 9B will not be applicable, although reconstitution is there in 9B, but it is not applicable because I received 4 crore, 3 crore is my capital, 1 crore will be capital gain, taxable under 45.4. Now, I did not get any money. The company gave me asset whose market value is 5 crore. My capital is 3 crore. 5 crore minus 3 crore. 2 crore will be covered under 45.4. Liable to be taxed in the hands of specified entity. And then we come to 9B, read with 45.1. We will take what was the value of the asset? Which I said, market value? 4 crore. Yeah, 5 crore. 5 crore. Market value 5 minus 3 crore, 2 crore. Now 5 crore is the market value. Then the firm will see what was the cost of that asset. So they will calculate capital gain under 45.1, consideration price 5 crore, less cost of acquisition or cost of improvement. अगर वो short index or index है तो index allowed. If not indexation, if it is a depreciable asset, no indexation allowed. Capital gain will be there under 45.1 if asset is received. Two tickets. One in the hands of both in the hands of the firm. But one difference between the value of the asset minus the capital account. Second, difference between the consideration price minus the cost of acquisition or index cost of acquisition as the case may be. Third case, there is a reconsideration. I am given asset as well as stock in trade. For the value of asset, both section applicable. 45.4 as well as 9B. But for the purpose for stock in trade, only 9B read with 28 will be applicable. 45.4 will not be applicable. We will not take the 45.4 as a consideration for that. But at the same time, if it is a dissolution, 45.4 will never be applicable. It will be only applicability is of 9B read with 45.1 and 28. So my point is, and if you are giving only amount to the extent of the capital, nothing is applicable. 45.4 is not applicable. 45 may be applicable 9B, but 45.4 is only when you give the money or the asset the value which is more than your capital, which is more. If it is a less than capital, 45.4 is not applicable. 45.4 will only be applicable when you receive money plus value of asset or both exceeding the amount of capital. And this difference will be treated as a cost of acquisition for future purposes in the hands of the firm. How would they treat it as a cost of acquisition? That they will prescribe under the rules which will become in the due course of time. Right, sir?
Yes, sir. There are just two issues about this reconstitution further asked. That there is, say, 1 crore rupees credit balance to a partner's capital account, and on retirement he forgoes that amount, does not take anything from the firm. What will be the fate of that amount in the hands of partnership firm?
My point is that if it is capital, how can he forego his capital? He has to make a gift to somebody. He cannot make a gift to the firm. Is he making a gift to somebody of that capital? Or it is treated as loan? Or what is it? If otherwise, if it is a gift to the firm, 56,210 will come without consideration. The money is given without consideration, according to me. There is a money. What is capital? It's the money.
Yes.
You have to take the money. So my point is, then there will be if it is given to the firm as a gift, you are making a gift of the money to the capital. Or if it is given to some other partner, it is other way case. So my point is, foregoing your capital has no solution. You can make a gift to your brother, you can give to relative, but otherwise no question. But if you make a gift, section 56.210 is now applicable if a person receives from any other person or person a sum of money exceeding rupees 50,000 rupees without consideration. This is without consideration. It is really a without consideration, according to me.
No, if the
you may say that it is not in the form of money. You may say it is not in the form of money, but it is a liability which has been share capital is what? A liability foregone by you. Am I right? And given to whom? They say it is indirectly, according to me, it will be made, they may take it as indirectly in the form of money. As if we have received the money and given back to the firm. As if.
Right.
Grey area, definitely grey.
Yeah. Because in some cases, say like newspaper company, if there are already defamation suit claiming say 10 crore rupees compensation, and which is hanging in balance, so one may say that liability may rank, so we will not pay you, and he agrees. So in such cases,
that liability can be 41.1 also, but that liability is 41.1 means that income of the firm. If it is, but this is not the case of partnership.
Yeah.
This is not the case of partnership. I have to think over there is a grey area.
Yes. And in respect of assets received by the partner, or the money received by the partner which is in excess of his capital account balance, what will be the fate of partner, whether it will be considered as income in his hands, and what will be the cost of acquisition of that asset for the purpose of subsequent sale by partner?
When I received money against my capital, right? My capital was 2 crore. If they have given me 2.5 crore, 50 lakh has been already taxed. I will not be taxed again. It has already been taxed in the hands of the firm. Why should I be taxed with the 2,50,000 that amount? Nothing has been said about that because it is actually my money. I am receiving it, but on my behalf, firm is paying it. So it is a case which has been taxed in the hands of the firm, like dividend. Earlier dividend was but they should have given this exemption. They say any share of profit which you receive from the firm is exempt. It's basically when you give more than it's a share of profit. It's a method of distribution of the profit. So they may say that it is exempt under section 10(2)(a).
Can they cite section 56(2)? in
No,
partner side?
I don't think. No. 10(2)(a). It is a profit which is given to the partner.
So profit will be even beyond profit and loss account or beyond income.
They say the profit or gain arising from this will be taxable in the hands of firm. So profit or gain, they are already saying at the end of capital gain. That profit or gain is in the hands of a tax, but if it is a profit, that profit is ultimately of the partner. So I don't think they will call it a 2(2)(a), 10(2)(a). They will say no, it is not taxable under 56.
And about cost of acquisition, will it be fair market value of asset on the date of acquisition by partner?
Yes, obviously. Obviously, the normal provisions will be applicable. Because already tax has been paid on that on the basis of market value. Your cost of acquisition will be the market value. There is no need to say about
just before I conclude, I would just ask Anuj Bhai whether he has any query to ask.
Yeah.
And thereafter Satish Bhai.
Yeah, some of the members are asking to Ahuja sir that is there any update for ITR extension?
Sir, that Mr. Chitle will be better to tell you. But let me tell you, if there is an extension, the scrutiny notice can come after 15 months. So here 31 months, the scrutiny notice 30th June. Earlier then there was 3 months from the end of the financial year in which the return is furnished. 3 months from the end of the year in which the return is furnished. So if the date is extended, it will be next year.
Yeah. And one query is, sir, please clarify whether temples are exempted from filing return under section 1023BBA of Income Tax Act.
You want to again come again, sir?
Sir, please clarify whether temples are exempted from filing return under section 1023BBA.
1023?
BBA.
BBA. Sir, BBA, I'll have to check up section 139(4)(c). If you give me 1 minute, I can check and let you know. Give me 1 minute. Because there are so many, I don't think that is there. Let me check up again. Let me check up.
Hereafter, Satish Bhai, we will hand it over to you for any queries and conclusion.
139(4)(c), I'll tell you in a minute, sir. 1 minute. 139(4)(c) talks about this section or not? Let me check.
10:20, 8:20 तुमको 5 मिनट बाद.
Which section you said, sir?
1023 BBA.
BBA. 1 minute. No, sir. No, not required. Because the sections are 1021, 1022B, 1023A, 1023 AAA, 1023B, then 1023C onwards. So no, not requirement. No requirement.
Right, sir. Right.
This is 139(4)(c). Let him check up. Now he has to read faceless assessment and faceless everything. So ask him to read section 139(4)(c).
Right.
Well, thank you, Girish sir, for elucidating on very important topic. And really, from tomorrow, we are going to see this law, unless it is a retrospective amendment. So, for concluding remarks and for proposing vote of thanks, I hand over to Honorable CA Satish Gupta ji.
Thank you, Chairman. Sir, before I come on my next part, I would ask 2 more questions, sir. Number 1, what is the position of 206C1H on services?
206(1)(h) for?
Whether it is 206C1H, TDS, TCS provision, whether this is applicable on services, supply of services also?
No, goods only.
Your sale of goods? On goods only. And
only
sir,
goods.
Okay, sir. Thank you, sir. And sir, one more thing, sir. Kindly give some hints to all the members what steps they must take from 1st April 2021 onwards. Any major points, sir? Because these are the time when all are facing.
Their voice was not coming clear.
From 1st April 2021 onwards, what precautions members should take while dealing in the income tax proceedings, while new things have come?
No answer, sir. I can't comment on this.
Follow the opening remarks of Girish Ahuja ji.
No comment. I can't make it up.
Okay, sir. So, I am really thankful to Girish Ahuja, sir, for the wonderful deliberations. And I tell you, our chairman said that he has read his books and has become CA. I tell you that even after becoming CA, we have referred his books. And he is always available to the profession. Any member can call him anytime, and he helps the members in the session as a very tremendously. And I think all professionals are thankful to Girish Ahuja sir for his tremendous efforts, not only by deliberations, but he is always available to the profession. And thanks to for the today deliberations also, I would request Chairman sir that this double taxation point on 9B and to be taken care of, and if we can bring it into the notice of the government at a right platform.
They will not agree. But I tell you one thing. I will tell you one thing. 56(2)(10) seller and buyer.
They are giving deductions.
You used to say double taxation. One from the point of view of seller, another from the point of view of the recipient, buyer. They did not agree. Here also saying that since you are getting more the money, what you have contributed, so the tax is there, but you are not paying the tax. Companies, the firm is paying the tax. And another is deemed transfer, that they are transferring the asset, so there should be a capital gain. I have fought with them. After this, I have gone many times. They are saying it is a wonderful provision. I said, "Mera dil manta nahi hai, अच्छा नहीं है." Lekin let us see. We can always represent, but they like it.
Yeah, we have a vice chairman. We have a vice chairman who says, "Ye dil mange more."
I am thankful to our Vice President, sir, in his absentia, for his opening, for his blessings, and all the members present here. And my hearty thanks to my chairman, who is taking lead from front and taking the directors committee on a new front, on a new level. And thanks to Anuj Bhai also for sparing his valuable time. Thanks a lot to all my dear friends who have attended this webinar, despite the fact they are very much busy today, and they are facing even the toughness of the site also, but still they are in a big number they are here. Thank you very much with my heart. Thanks a lot. Thank you very much.
Thank you, Girish.
Thank you everyone. Take care, sir. Take care.
Yes, sir. Thank you.
Thank you, sir. Thank you.